We wouldn't even be having these discussions about climate change if there was a functioning carbon market. I don't think the political debate is in a place anymore where we can actually debate that and go, how are we going to get a carbon market? So industrial policy is probably something that is here to stay for a very long time.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, where trading in centrally cleared, physically deliverable LNG and carbon futures contracts is now underway. Ready for smarter markets?
Welcome back to Inside the Coffeehouse on Smarter Markets. I'm Dave Greely, Chief Economist at Abax Technologies. In this podcast series, we're introducing you to Coffeehouse, Smarter Markets' new social media platform for advancing the conversation on energy, climate, markets, and technology. It's a space where the executives and icons you listen to on our podcast can engage with each other in thoughtful conversations, disagree without being disagreeable, and discuss how our market systems can be redesigned and improved to address the most important challenges of our time, including climate change and the energy transition. That feeling of grabbing a cup of coffee with colleagues to catch up on the important issues is what we're creating on this platform, and our Smarter Markets members are invited to follow the conversation. If you'd like to learn more about Smarter Markets Coffeehouse or join our waitlist, visit Coffeehouse at www.smartermarkets.media. Building new markets begins with the exchange of ideas. Many of today's great exchanges were born in coffee houses, including the New York and London stock exchanges. At Smarter Markets, we're building our virtual coffee house to facilitate the exchange of ideas that will lead to the smarter markets of tomorrow. Our guests today are Jeff Currie, Chief Strategy Officer at Energy Pathways at Carlyle, and Arjun Murti, partner at Veriten and publisher of Super Spiked on Substack. We'll be reuniting these two former Goldman partners and colleagues to share their perspectives on the market, economic, and political forces shaping the future of our energy markets. Hello, Jeff and Arjun. Welcome back to Smarter Markets.
Happy to be here.
Great to be here, Dave and Arjun. A long time no see, both of you.
Absolutely. And I want to wish you both a happy Thanksgiving. I know that this year I am thankful to have you both here for a Goldman Sachs energy reunion of a sorts. And there's a lot to talk about. And I wanted to start with what you both see as the significant developments that will likely shape the course of energy markets and the energy industry going forward. We can look back at the Russian invasion of Ukraine as one of those. Now it seems that the return of President Donald Trump to the White House with the Republican House and Senate will be one of those. But what do you think? What are the big developments that you're tracking now that you think will shape the path going forward? Maybe we can start with you, Jeff.
I want to start with the big one. Everybody assumes that Trump coming into power, that the energy transition is going to slow. I think it's just patently false. Why? Let's look at Trump 1.0 versus Biden. Let me remind everybody the world got greener under Trump 1.0 than it did under Biden. Let's look at the measures. Investment in renewables went up during Trump. Oil production struggled to grow during Trump. In Biden, we're producing 20 million barrels a day, everybody. Let me remind you, 20 million barrels a day. The overall investment in renewables slowed under Biden, which tells you while Trump may control the House, the Senate, the Supreme Court, he does not control the bond market, nor does he control physics. And so when we think about what happened under Trump 1.0, you had low interest rate, low oil prices, and hence you got the big investment in renewable energy. Under Biden, you had high oil prices, high interest rates, and as a result, you ended up with low investment in renewables and large investment in oil. Going forward, and when we talk about the outlook on oil, I think the U.S. is going to struggle to grow output. When we think about the deregulation that Trump's going to do, it not only deregulates the ability to do brown, but it also deregulates the ability to do green. And also, when we get further into it, I'm going to make the arguments that what's driving clean energy investment. In fact, I probably like to use the term, call it zero marginal cost energy, is more to do with energy security than anything else. So I take a very different view here that what Trump 2.0 is going to do, it's going to create energy dominance of both green and brown as we go forward in terms of thinking about the US.
What do you think, Arjun?
I'm going to add to what Jeff said. I think we have a lot in agreement here, actually, which is when you think about Trump 1 versus Trump 2, you're going to bookend periods, I'm going to call it going from and returning to normalcy for energy markets, which means it's going to be the outlook for growth, economic growth, the outlook for growth for specific technologies, and the profitability or cost of supply to produce these things. And what do we have in between? It was towards the end of Trump 1 that I'm going to call it ideological ESG. As an equity analyst, we always cared about things like governance and the health, safety, environment that our companies would focus on. But this idea that climate action, quote unquote, was going to be the driver of energy. And then these net zero promises after the Paris Accord that started just before Trump came into power. All that stuff took over during Biden 1. And suddenly every company on earth had to have vowed to have a net zero objective. And my big issue with it is not that we someday need to decarbonize. I actually don't take issue with it. But that somehow counting carbon was going to be the path to how you have energy development. And I think we're going to actually head back to the healthier environment where it's going to be the outlook for economic growth. How do you meet that growth? What are the technologies that are going to drive it that we're returning to? I agree wholeheartedly with Jeff on the point that it's going to be availability 24/7, 365 and geopolitical security in every country and every person's desire to have those things. That's going to drive both traditional energy development, but as critically, new energies development. If you're a country that is short crude oil, you're not going to want to get to the position where China is today of importing 12 million barrels today. I think that's going to be an overwhelming driver of motivating new energies, but that's very different from the mindset that we're trying to, quote, solve an urgent climate crisis. I'm not trying to make fun of the environmental goal. My comment is simply that to achieve it, you have to start with what everyone solves for, which is energy availability 24/7, 365. And that is going to be both new and traditional energies.
I'd love to dig into that a little bit deeper with you, Arjun. As you've stressed in your super spiked writings and videos over the past few years, we need to look at many of these developments from a global perspective and not get too locked into, what's happening in just the US and Europe. And you've always stressed that need for affordable energy in the global South and the need for secure energy in China. And that can be equally or as more important than the push for low carbon energy in the US and Europe. And so when you take that global perspective, what do you think we should be thinking about for the future of the energy industry today beyond the US elections?
To me, David, the numbers are just so overwhelming. I'll use the phrasing that there's the lucky 1 billion of us, those in the US, Canada, Western Europe, Australia, New Zealand, who use a disproportionate amount of the world's energy, and the other 7 billion people on Earth, soon to be 9 billion, who are trying to move up economic and therefore energy S-curves. And we can debate the timing of economic development in some of these countries. Unfortunately, large parts of Africa and maybe Latin America are a little further behind in terms of where they are. But you got 4 billion people in Asia that unquestionably are trying to get to where we are today, where Europeans are today. And that means lots of all forms of energy. We've been in a world where people and their energy scenarios have been counting carbon and counting degrees of warming. Again, not dismissing that we need to address these things. What I'm questioning is, how are you going to get there without first and foremost solving everyone's energy needs? There is not a person or a country on earth that ever said, yeah, I'm willing to sacrifice my energy use because it's not the right form of energy source. No one's made that decision. Germany, when Russian gas was cut off, didn't say, hey, yeah, we have these climate goals. Let's do without energy for a while. No, they not only imported LNG, they started burning lignite coal. And we see that in the US when we have hurricanes. No one says, oh yeah, great, I don't have to consume carbon today. No, all they care about is, where's my generator? Where's my power? I'll pay anything for it. But all of that is not to say there isn't going to be a huge motivation to crack the code on what comes next. And it's going to be trade flows. It's going to be geopolitical security. If you are a country that is short crude oil or short natural gas, you're going to want to do other stuff. So I do think there's a huge role to play for something like solar, especially if you're in a country like India where the sun shines strongly. But how do you then baseload that? The base case is actually going to be coal. So if you're an environmentalist, how do you motivate your base load to move off of coal? And whether it's going to be nuclear, geothermal, natural gas, we can debate all these things. But there's a high hurdle to do that. A lot of these new technologies are more expensive than if you're a country like China or India with a lot of coal, you're going to burn that first. The challenge to me, it all starts with how can everyone ultimately become energy rich? That is unquestionably, I think, a societal objective. It's unquestionably the objective of every country and every person on earth. And then what are our energy scenarios to get there has been my focus.
A lot of great stuff for us to follow up on. And, one thing I wanted to dive in with you, Jeff, it certainly seems that China is now out front in that race to develop and install renewable power, move to electric vehicles, and secure and produce the critical minerals necessary to transition to a more electrified energy system. How are you thinking about the role that China is playing now in reshaping the future of our energy system?
Well, I think going back to Arjun's point about issues around, call it energy poverty in the global south, China has created a lot of these technologies and instruments that are going to go a long ways to solving these problems. You take some of the hybrids, these things can go over 1,000 miles on one tank of fuel, and they're like $14,000. So you're talking about significant advances in technology. I know you guys live in the States, you don't ever get to see the BYD dealerships. I have one down here. I have to say, I walked by there, and it's where the old Land Rover dealership was. And these things are half the price. And they actually look, one of these days I might walk in there. By the way, they remind people that when the Japanese invasion of autos in the 60s and 70s, people were reluctant to buy them then. But eventually they came around to doing it. And, you look at the capacity to produce EVs, somewhere in that 25 to 30 million units per year versus the US market at 16, 17 million units, Europe at 14, China's at 25 million. By the way, total amount of EVs on the road is about 40 million right now, or is it 1.2 billion cars? So it's small, but the point I'm making here, China has the capacity right now to nearly double it. And also you look at the West, they revealed a point that Arjun was making about their preferences for dealing with climate change. They said it's very, very pressing, but then when push comes to shove, blocking through trade policy, Chinese green products seem to have been more important. But I don't want to underestimate the impact that China is having here. And I want to go to a broader point here, is I liken China's investment in green technologies to U.S. railroad investment. When the U.S. invested in railways, it was absolutely capital destructive. They were using British capital and American land at the time. But the number of dead companies along the way to get there was enormous. But in the end, once it was done and completed, it was a game changer for the world. They connected the Pacific with the Atlantic. And look at the motivation for investment in green technologies in places like China. It's impressive in the sense that they're doing this more for energy security than they're doing it for climate reasons. And when we look at the fact, they're burning enormous amounts of coal to fire the EVs, it's pretty revealing. But who's winning the transition? They are transitioning so fast. And why do I liken it to railroads in the United States? Because once they make the investment in these technologies, it's zero marginal cost. Let me repeat that, zero marginal cost. If the US sticks with the fossil fuels and other types of fuels, it has a much higher marginal cost basis. And let's go back to economics 101, sunk costs. Sunk costs won't matter 50 years from now. And that's what the US benefited from the railroads. So if anything, the motivator to do this has left being climate change and has really started to become energy security. And when we look at Europe, now Europe has done it, but they've done it in a way that they made themselves very vulnerable. I'm going to go back to Arjun's point, 12 million barrels per day. They actually reached that in 2019. They haven't gone above it. And that's 25% of the global seaborne market. They don't want to go above that. And when we take all of their hydrocarbon or fossil fuel imports, they're actually going down when you put coal and gas into it. And their renewables are growing at such a fast clip. All they have to do is keep the coal constant. the key message here. Yes, the US has energy dominance in both fossil and green fuels, energy dominance in joules. We need to erase that artificial color line between brown and green energy and focus on the joules. However, from a cost basis, what China is doing by accelerating that investment and all that green capex, they're putting themselves into a position 15, 20 years down the road to be, a zero marginal cost. And that's, again, like the railroads, it's a game changer.
I'd love to dig into that some more with you, Jeff. We had Eric Varnes on with Susan Sackmar last week, and he had kind of brought up the issue that China, like Europe, is kind of energy poor, whereas the US is very energy rich. And when you take a step back, it always seems like the whole idea of transitioning to low carbon renewables, there was a tension with energy affordability and security in the US because we have so much oil and gas wealth in a way. And for China, that's on the same side of the ledger, right? That the more they transition to electric and renewable, the more secure they are, not the less, because of their low oil and gas production capabilities. And so I want to tie that to something you brought up earlier about the transition to green under the first Trump administration versus Biden, because of course, in the US, we've had the Inflation Reduction Act. We've got a lot of subsidies going into transition areas. Europe's tried to be more regulatory about it, tried to be more, let's regulate the transition. When you look at all these things in balance, how do you think the US will be able to maintain its overall joule dominance? Or do you think that torch is going to pass to China as we look out 10, 15 years?
I will never bet against the Americans in understanding these issues. And I think there will end up being a very deep understanding. Just look at a chart, the joules balances in US, Europe, and China, and line up all three. It becomes crystal clear what these risks are. Europe clearly did not understand the significance of it. Because what do? They cut their own domestic production of fossil fuels and then didn't grow the green fast enough, and they're importing more. While you look at the US, it's exporting more and on the fossil fuels, but you look at China, as Arjun pointed out, they won't go above that 12 million barrels per day, hit it fixed, and built the renewables very quickly. You start looking at pictures like that, and you recognize that, hey, they developed these nuclear technologies, and they can roll them out a lot faster than anyone else on the planet Earth. Their ability to surpass the US in joules dominance starts to become pretty apparent pretty quickly. So, you look at the US, they've got to be completely conscious of this, particularly focused on trade issues with China. I don't think it'll be lost on the Americans in the same way that it was, for a lack of a better word, lost on the Europeans.
And Arjun, you spend a lot of time talking with companies, thinking about companies and their development. How do you think the U.S. energy industry is thinking about these issues?
Again, I hate to do it, but echo some of Jeff's themes, but they may be from just a slightly different angle. I think as a country, and we can debate whether we throw Canada in here as well, we are on track to continue to dominate crude oil. Largest producer, has grown the most. The growth may slow, but we're still going to be a very important producer, and LNG. There is a question, though, on the degree to which and how the IRA can be reformed, I'd say, rather than repealed, to ensure we also become dominant in the new energies. And I might contrast this with the mantra of, I'll say, the last several years. I actually don't blame the Biden administration per se for this, but that sort of activist, climate is all that matters mindset, that we need to transition quickly, which means primarily in the last 4 years, yelling at traditional fossil fuel companies, somehow only in the US, Canada, and Europe, to quote, keep it in the ground, but of course only in those countries, and then pretend we can do only renewables and EVs over an arbitrarily short time frame. And that to me has been the issue. And I'd say, I think it's actually critical that we develop, nurture, motivate all aspects of the new energies value chain. Some of that's critical minerals, mining, refining, and processing, which of course is dominated by China. Can that all come to the US? Probably not. So what are the friendly allies where together we can do more of this kind of stuff? How do we motivate, again, things like geothermal, things like nuclear, both traditional and advanced nuclear developments? All these things we should be looking to dominate. And I think on the marginal cost, which Jeff makes a great point on, my issue with the US is let's motivate demand substitution, not supply, keep it in the ground. I'd argue we should be looking to maximize whatever that means in terms of volumes or output. our crude oil, domestic LNG production, and send it to the countries that are still going to be demanding it as they move up their economic and energy S curves. And then how do we think in the US of increasingly going towards, whether it's efficiency technologies, whether it's some substitution or so forth, how do we continue to look to improve our multiplier of GDP relative to domestic energy demand? It's just a different way to look at transition. I think the final point I'd make, Dave, and I don't know if we'll fully get to it today, is where I think there is optimism and where I feel good about the direction we're heading is in the power sector, where there is now an overwhelming recognition that we have an aging grid. We've added a lot of intermittent resources. At the same time, we've prematurely retired some base load, and we've got new sources of demand, including hyperscale data centers. And all of that is driving a fresh look, including from non-energy companies. One of the problems with energy is it's been energy nerds and energy oil companies and climate activists that have debated this. It's great to have a broader societal recognition, especially by big tech companies that are dominant in the market today, to begin to understand how do we use energy? Where does it come from? What are the different attributes? There's no such thing as green or brown or clean or dirty. They all have pros and cons. And how do we solve for the totality of that? And it's probably what I feel most optimistic about is the fact that the power conversation is bringing in a broader group of companies and industries to think about energy.
People have always turned to the two of you for deeper insights into the big forces that are shaping the context in which events and developments that we've been discussing so far play out. And, listening to the conversation so far, politics as well is kind of constrained by things like interest rates, by things like energy prices, by previous investments. And so I wanted to ask you how you're both thinking about it now. What do you see as some of the big important forces that are framing your outlook for energy markets and the energy industry? Maybe we can start with you, Jeff. How are you framing up the whole thing right now in your mind?
Let's start with what car is most in demand from consumers right now. It's a hybrid, an HP EV, not a BEV, not an ICE. Why? It's energy security. By the way, here in the UK, there's times where you want to be able to plug that thing in, and there's times where you want to be able to go to the pump. You guys don't experience that in the US like I do here. However, it illustrates that the consumers, whether if it's range anxiety, whatever it might be, want an automobile that can operate off petrol, operate basically oil, gas, solar, wind, nuclear, coal, the whole gamut of the entire ecosystem of energy sources. And I think that portfolio approach is pretty much the way to be thinking about it. We go back to, it's not about electrons. It's not about molecules. It's about joules. And we want to be able to maximize the joules at the lowest possible emissions and at the lowest possible cost along with the highest returns. And we start thinking about it in that perspective and also focused on the energy security. We're solving all the same problems at the exact same time. But I think it's letting go. Again, you got to start with, get out of that debate around brown versus green, think about the joules and think about these balances more broadly. And when we do that, and I know this, Arjun, you remember back in 2000, we were writing reports about how the world's going to be gas, 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 gas. It's 24 years later, and we're just now getting there. And I think that gas is the new flex fuel. It's the one that can, if you're sitting in that portfolio, it's the one that can always solve all the problems that you could possibly run into. And I think when we talk about oil, everybody's trying to understand today's oil prices. I've been out there, it's, the investors, they don't like oil anymore. It's 2 years going, so I clearly am wrong. And, whether it is consensus view, it's bearish. Well, there's no evidence of the bear view. I've given up. And when we saw the movement in break-even inflations in September, it's just a line going straight up. Overlay it with TTF. I think, Arjun, finally 24 years later, that utopia world where gas is going to be pricing everything at the margin has finally arrived. And that's what's going on. Oil is no longer the marginal BTU of this portfolio of energy sources that we have arrived. It's gas, it's LNG. And Dave, with AVEX, that's what they're offering. They're offering a global benchmark for LNG, and I don't think it could be more perfectly timed than it is right now. So if we think about this new ecosystem of energy supply sources, gas is the flexible one, and gas is the new macro variable. It's the one that's going to be driving everything going forward. So, I feel kind of foolish. We've been talking about it for a quarter of a century. It happened. I'm not going to say we're 100% past the Rubicon, but I suggest everybody go back and look at TTF and the 10-year and break evens. It seems to be the new macro variable, because think about gas is used in trucking now, gas is used in data centers, gas is used in particularly almost every application we can think of. So anyways, that's my 2 cents on the new paradigm.
How about your 2 cents, Arjun?
I think Jeff, it has indeed taken our whole careers for gas to kind of finally become, quote, global. I'm totally with you on it. And I think there's a pretty bright future. I think where in the value chain should companies or investors participate, that is of greater debate than necessarily the growth in gas. But I wanted to get to a different sort of big topic, which is I've pushed back, and there is pushback on this, quote, the energy transition trademark and all that it's meant, which is, I think in the last few years, we're going to get out of fossil fuels and only go into the new stuff, which of course is just renewables and maybe EVs over some arbitrarily short time frame. And that framework, I think, is on track to be vanquished. But that doesn't mean there's no transitions going on. And I've started to use the term perpetual transition. I go back, Jeff, before we started working together, and Strong and you hired Allison and then you. And I remember one of the first calls, I was on the buy side, was the Thai baht devaluation of 1998. And that Asian financial crisis marked the end of the Asia tigers and tiger cubs. And that was the dominant driver of growth. And even in those days, early in my career at JP Morgan and Petrie, we used to go to Japan and Europe to figure out what oil demand was in those countries. I mean, Jeff, when was the last time anyone asked you about Japanese oil demand, or for that matter, European oil demand? And the Asia tigers and tiger cubs, I had to look up whether these were still acceptable terms or not to describe those countries. And I think it is. So hopefully this can stay in the podcast here. But my point would simply be, from 1998 to 2004, it was uncertain what the demand growth for oil and gas and energy was going to be. And we actually went through a period where people were debating back then. Maybe these things are mature and peaking, and Europe's got demographic challenges and Japan's got demographic challenges, and we've had the best of these. Of course, it was 2004, China WTO. We know the whole super cycle story. We're going through one of those transitions now. China's got some demographic challenges. They are, at least in terms of energy, transitioning to electric vehicles. I will say, I feel like we've done okay with that part of the call. LNG trucks has completely taken me by surprise. They did not have the kind of ramp that they're doing there. So you are always transitioning, but it's not the energy transition where we're going all of that to something, only into something else. Generally does not make sense due to the laws of physics, due to the laws of economics and these kind of things. I think that's what we're mindful of. We're going through some transitions now where global gas is suddenly coming up front and center. And we don't know what is going to replace China going forward. I suspect it's not totally over for China. I think they're going to continue to have economic growth, but one could debate that. What is the timing and pace of India relative to China 20 years ago? What is the timing and pace of the rest of the South? All these are the kind of questions we're evaluating. But what I feel good about it is we're back to evaluating the normal questions. What is GDP growth? What are the economics of all these different technologies and sources of supply? But we are always in perpetual transition. And sometimes they catch you by surprise, and sometimes you get it right. And that's what your job is as an investor, as an analyst, or frankly, as a policymaker as well.
Such great points to remember, that these things take longer to unfold than you would expect, and then often seem to happen all at once, right? People have talked about natural gas as a transition fuel. And I think sometimes they talk about it's like, oh, that'll be 3 or 4 years. But, obviously it takes longer. It took 24 years, you said, for gas, move from gas to be at the center stage from oil. And, now we see gas, as you were saying, Jeff, kind of at the center, that marginal jewel in the global economy. And I wanted to ask you, how much do you think, in terms of getting to our new energy future, are we going to need to do things like China has done, in that get that alignment of security and affordability with environmental sustainability? Arjun, I've seen many conversations of energy development in Southeast Asia, the global South, where the appeal of things like solar is because it's distributed. You can have it in your backyard. You have the energy available. You're not reliant on LNG that Europe may take away from you when it gets short. You're not reliant on building out a massive grid or pipeline system. And I'm wondering, is that part of the path forward, particularly outside of areas that have big existing infrastructure like pipeline and grids? Is it going to be looking for the appeal of these renewables in terms of they're being more distributed? I go back to, we all learned a lot, I think, from Steve Strongen. And one of the first things he told me was commodities and energy, it's logistics. And like, do we need to focus on the logistics of these sources? And as Jeff was saying, the flexibility.
A big challenge of the last several years has been all scenarios. And the IEA gets a lot of headlines and they get picked on. But look at all the big oils. Their scenarios are no different. They have different CO2 and warming scenarios. And again, there's no comment in here. We shouldn't take those things seriously. But I do push back that that's going to be the pathway, that philosophy, that type of scenario analysis is clearly not on track to happen. I mean, there's no evidence it's on track to happen. I would start with, how do you get to, we can debate the decades, we can debate the century, where everyone on Earth is energy rich and has the kind of lifestyles we take for granted in the US and Western Europe. And we can call that utopia. I'm going to call it, that is true environmental and social justice. We are all similarly rich. I am a capitalist. And then when you start building out for the types of the quantum of energy that you need, there's no chance you're going to want to do this entirely with fossil fuels. And so I'm going to always disagree that somehow we're picking environmental goals or energy sources. Clean air, clean water, resilience to adverse weather events are 100% correlated with being a wealthy society. It is also true that biodiversity and carbon emissions are inversely correlated with societal wealth. What I will say is geopolitical security, availability and abundance and affordability, especially for countries that do not have sufficient quantities of crude oil, most notably, but also natural gas, that's going to be positively correlated with lower carbon emissions. You will decarbonize by focusing on what India and how they're going to want to develop. And as Jeff pointed out, as we've already seen in China, China freaks out about 12 million barrels of crude imports. They push the accelerator on new technologies. Now, they do have a lot of coal. So to me, the environmental question would be, to what degree can you clean up the coal? Can you carbon capture it? Or how do you motivate replacement with geothermal, nuclear, natural gas, presumably with the methane abated and with CCS potentially? If there's going to be a carbon emissions component to it, it is going to be the coal displacement. And frankly, the most unrealistic forecast in all these traditional net zero scenarios is actually the coal number. I mean, I'm willing to concede there's a debate over oil demand. I think it's going to grow for the next 10, 20 years, but I concede that you can debate it. Jeff and I think both agree natural gas is going to grow, but at least there's some uncertainty, especially for how much LNG is going to be imported by countries with coal. What debate is there over coal? Why is India not going to follow in China's path? And so again, if you're an environmentalist, how are you thinking about motivating to displace the rest of it? You got 7 billion people. They're not going to want to be buying all their oil from Russia or Saudi, or for that matter, from US shale producers or Canada. It will decarbonize. I think it's false today, so to say, we know how to make everyone energy rich with the technologies we have today. Some of it will be technologies we have today. Some of it are still to be developed and discovered or commercialized. And that undoubtedly will happen over the next ensuing decades. And we spend a lot of time, I do, at Veriten we do, on trying to figure out which are these new energy technologies are the ones that we should support and invest in and that are going to scale profitably.
And I want to get into the question of how do we put our wealth to work? Both of you have always been very, very good at emphasizing that it's where our investment dollars are or are not going to work that kind of shape the longer trends in these markets. You know, Jeff, going back to the late 90s when you were talking about the revenge of the old economy because investment was flowing into tech and not into traditional commodity sectors. And Arjun, you seeing the lack of investment and seeing that as part of your super cycle framework, which has kind of now become part of the vocabulary of these markets. So I wanted to ask you both, what is shaping where investment dollars are going in the energy and markets and industry now? A few years ago, a lot of that seemed to be ESG. Curious if you still see that, or has that gone by the wayside? So what's shaping where investment dollars are going? And what is the impact this is likely to have on energy supply and companies in the future? Maybe I'll give you the first shot at it, Arjun.
I think it's always been, and we're returning to the idea that it's profits and growth. So a decade ago, we had a lot of growth in shale without profits. Investors said that does not work. Those companies are back to focusing on profits. Previous 5 years, it was a lot of new energies. That came with a lot of growth, also without profits. And again, I think Jeff pointed this out at the start. One of the great ironies is, quote, new energies did actually best under Trump 1 and did extremely poorly. I'm talking about the equities under Biden, as investors start to realize a lot of this growth was not coming with profits. Just look at the tech sector, look at any other sector. It's always the combination of the two. So I think what we're looking for is with traditional energy companies, they're doing better on the profits front, but investors have questioned what is the sustainability of their growth. Maybe their shale plays are mature, or maybe people have doubted the long-term outlook for oil demand and perhaps to a lesser degree gas demand. I think they're going to come out more favorable ultimately on the quantum of future energy growth, of which oil and gas will be a component of it. But it's still going to be incumbent upon companies to say, here's our portfolio of low-cost projects that can be profitable down the road. Same thing with new energies. Again, we're not for or against anything. We're going to push back on, oh, the growth is there in the name of carbon emissions, but it's not coming with profit. So who are the folks in that new energy space that can scale up profitably? And again, one of the places where I think everyone's meeting in the middle is on the power side. Look at the merchant power producers in the US, Talen, Constellation. None of these are stock recommendations, but over the last year and a half, they've performed as well as NVIDIA. Greatest, hottest company on earth, NVIDIA, matched by merchant power producers. Why? It's the Mark Andreessen of Andreessen Horowitz line. Software is eating the world. We've all learned all software requires hardware and all hardware requires power. And so where can we get profitable growth? Somehow it's with tech companies. It's increasing with merchant power. What else can we add to that spectrum? I'm a big natural gas bull, but that doesn't mean you'd want to own every natural gas producer. We've got zero or negative prices in the Permian. So where in the value chain do you want to invest in natural gas? Is it actually on the production side? Or is it from folks who can take advantage of inherent gas price volatility and going to wherever the arbitrage spreads are? There are many different ways to think about these things. It's not about necessarily believing in a super cycle or not. I think it's about recognizing we're going to have significant energy demand growth. We don't know exactly all the different forms it's going to come in. Where am I going to get profitable growth? It's what I spent all my time thinking about, David.
Let me turn to you, Jeff. Where do you see investment dollars going today? What's driving them? And are they going to the right place, in your opinion?
Let's start with the observation Arjun just made. Constellation, Vistra, and Talen. What do the three all have in common? They have an ecosystem of energy assets, like I was talking about before. They've got gas-fired generation capacity. They have nukes. They have hydro. They have solar. They have wind. They got the full gamut. This allows them the flexibility. Markowitz diversification. It's a diversified ecosystem. It has reliability. It goes to your point. It can reduce emissions. It has reliability with the nukes and the hydro, and it has affordability. That's why those three have gone to the moon and everything else, with the exception of Exxon. I think Exxon is a different animal than the rest of the energy world, and I'll talk about that in a second. But I think the key point here is that diversified portfolio of energy assets. Going back to what's the highest demand car out there? It's the hybrid. Why? Because it's got electrons, molecules, it can consume anything. What do Constellation, Talen, and Vistra do? They can produce anything. And that's why they've got the bid for them. And I think that that's going to be what the portfolios need to look like going forward. But let's talk about Exxon. And I think that this is a really important development. It has gone into the stratosphere. Everybody thinks that the big companies that dominate the S&P are all big tech. JP Morgan and Exxon are in that list, which tells you, what do investors want right now? They want big, bigger, and American. And it's just the dominance that is taking place here. And it's because the passive investors, and going into COVID, passive investors represented somewhere around less than 50% of the US equity market. Everybody was trapped in their houses. Interest rates were at zero. So the only thing to do is buy things online like Amazon and then invest in US equity markets via ETFs and passives. And so we saw an explosion in ETFs. Now they represent 60% of the US equity market. And what does that mean? It means the big get bigger and their access to capital is enormous. I calculated the other day, Exxon could swallow BP and it only increased its market cap by 15%. That's just mind-boggling how big it's gotten. But I think it illustrates an important point here. It's going to make, let's talk about the rest of the energy landscape. You're going to have scale. I think we're definitely heading towards call it revenge of the old economy 2.0. And hey, I was taking a victory lap in late 22 and early 23, thinking we were there. Boy, was I proven wrong. I still think you need to attract the capital. And to attract the capital, go back last year, we had about $1.7 trillion go into energy. 700 of that was government money. By the way, everybody talks a big game about the IRA. It was slated for 85 this year. I don't think it's going to be more, close to the 85 billion because it's difficult to find the projects there. Europe was 110. Guess where all the nearly 500 billion of that 700 of government money came from? It was China. But there was $1 trillion of private sector money. It's inadequate. All three of us will agree we need massive amounts more capital to create far more Constellations, Bistros, and Talons. And to attract that capital, it's going to require higher rates of return in the space. And they're not there relative to big tech, the new economy. And so that's why I argue we're still poised for the revenge of the old economy 2.0. And I think we're going to get there. But I think what we need to see is start to see some significant upward pressure on returns. You're seeing it in TTF right now as we're talking about. Are we going to see energy crisis 2.0 in Europe? We'll find out this winter, and I'm not in the business of forecasting anymore. But, it's looking that way. We get another round of this, there might become greater awareness that we need to make that investment. And maybe that's going to be the catalyst to start to see that capital transition out of the new economy into the old economy. One last point I want to make on these passive investors is it's not a coincidence that Arjun and myself are both sitting in the private market now. Passives dominate the public markets. Active investors are being squeezed out. Energy requires active investors. And what this suggests is most of this investment's going to take place from the private markets, whether it's in private equity, private credit, in that you're going to see, because it's buy and hold. It requires taking a view. And right now, passive investors cannot take views. There's not a lot of IPOs taking place in the private space. Why? A ETF can't do an IPO. ETFs in the oil market, they can't buy oil based upon geopolitical risk. They can only buy it after it happens. So the fact that you can't see, markets positioning for fundamental views shouldn't be surprising because passive guys can't. The active is where it's going to happen, and the active is going to be in the private space. And I tend to think there's going to be more people like Arjun and I moving into the private space and being the ones that help create that investment. I'm a firm believer it's going to come from the private side.
What are your thoughts on that, Arjun?
This is such a great point Jeff is making. And when you think about the pressure public investors are putting on these companies to sort of stick to their lane, just dividend all the cash back to me. And I have a lot of sympathy to a lot of that. If you wasted money last decade, there is a need to right the ship a little bit. It's such a great point that in terms of what's going to be needed forward, who has the skill set to do that? It tends to be a lot of these executive and management teams. And there's not necessarily the motivation to do any of the new stuff that's needed to take different risks that is coming from the public crowd. The public crowd is saying, please just give it all back to me. Don't waste it this time. And we know there's massive investments that are needed. We know that energy is generally still very out of favor for some historic good reasons and maybe some not so good reasons going forward. And who can do that? It is going to be private equity. It's going to be private capital, but it's also these companies. And what is their ability to think in risk terms and to do some different things? And how do you do that without really upsetting your existing public investor base? As Jeff correctly articulates, is de facto passive anyway, which is kind of the great irony of it. So you're getting these loud comments from residual active investors who have almost no impact on the trading of these companies because they don't control the fund flows into them. These companies have a greater competitive advantage than they realize, but which boards, which management teams are going to take some of these risks? Jeff had highlighted ExxonMobil. When I was at Goldman, I'm going to get in trouble for saying this. This is my Goldman career. I call them the greatest company in the history of the world. And they're certainly back on top here in terms of having had very good stock performance. And they've taken some risks and some new stuff. And they've said no to other things that came from traditional investor pressure. What other examples are we going to see out there of companies taking risks at a time energy is generally still out of favor?
I love the back and forth. And so I think in the spirit of our new Smarter Markets Coffeehouse, I'm going to get out of the way here and let each of you ask a question or two of each other. Maybe I'll start with you, Jeff. What are you most curious about getting Arjun's perspective on?
Arjun's been banging on the table about India and the global south and their need to get to an industrialized level of development. And they're going to have to create the emissions. A stat that I picked up over the last year, Arjun, which makes your point crystal clear. If you look at lifetime emissions from 1850 to today, United States, 440 gigatons. Europe, 320 gigatons. China, 280 gigatons. Where is India? 65, which goes to your point about coal. So we look at the last two COPs. The North is willing to start to make payments to the South. You finally, Arjun, people have listened to you. They're getting their pathway. They're ready to go. You're not in the peanut gallery and can, make these points. How do they do it? How, your point, are they going to do it with coal? Are they going to do it with oil? How do renewables go in this fix? So you get you finally made your point. You're winning it. Tell us, how is India going to get there?
I think the honest truth is, Jeff, neither I nor anyone else knows exactly, again, how they're going to do it. But to me, the starting point is let's model honest scenarios. Maybe honest isn't the right word, but scenarios that get to what everyone cares about is how do you become energy rich? How do you become economically wealthy is really what everyone on earth absolutely strives for or cares about. And to me is the morally right state to get to. When we start with net zero frameworks that solve for CO2, we immediately start with limitations. Oh, we have to cap how much emissions we have. And you can say, yeah, we have to. Otherwise, we're going to warm up too much. I don't dispute the need to care about environmental goals. What I'm disputing is by starting with that mentality of limit. Look at all these net zero scenarios, Jeff. They all have primary energy consumption plateauing in 2050. That's insane. What does that mean? That means the poor world is going to stay poor. How is that okay? How is that environmental and social justice? It is pure insanity. If you want to make the call that they're going to have bad governments and strife and they're going to stay poor for just the normal reasons, then that's unfortunate. But to say that we're going to willfully limit them, we as rich Americans or rich Europeans are going to tell them what they should do. And I just say, we can have all the debates we want. You sit in London, you're American, I'm American, and sit in American, and David, you're here as well. It doesn't matter. It's going to be up to them. India is going to follow the path they want to follow. They had gained independence from their colonial masters. Same thing with China, same thing with the rest of Southeast Asia. We unfortunately probably do have to debate how free Africa is, and Latin America is a different situation. But for those 4 billion people, they're going to follow their path. And I'd say, let's start with, we can debate the year, 2100, 2150, 2075. What does a fully developed state look like? Again, we can debate whether we fully get there or not. If you solve, let's just take India. They use 1.5 barrels of oil per person. The rich world uses 13, Europe's 10, we're 20, Thailand 7, China's 4, South Korea's 22. It's just multiples of what India uses. If India were to get to 10 barrels of oil per person, that's 45 million barrels a day of oil demand. Their current production is 500,000 barrels a day. I will absolutely guarantee, without any doubt, there is zero chance India is going to want to import 44.5 million barrels a day when they're a rich country, right? So now let's just start peeling away at that. I don't believe electrification can take away 100% of the demand, but can it take away a quarter or third or 50%? What are our signposts? What is the copper that's needed? A point you've made, Jeff. Other critical minerals. Is that realistic by 2035? Or is that perhaps more realistic by 2080? And how do we think about that piece of it? How do we think maybe about LNG trucks displacing some chunk of petroleum diesel? Well, now we need natural gas. What are the attributes of that? Are we dealing with methane? Are we carbon capturing some of the other negative attributes of natural gas? It's all these kind of things. But I think there's a whole swath of technology that we've not really discovered or commercialized yet. Can nuclear scale up at a lower cost than what has traditionally been, at least in this country? Does geothermal play a role? I think undoubtedly solar is going to play a huge role in India. And some of the reasons, I think, David, you had mentioned it. You can't put a nuclear plant on your roof, but you can't put some solar panels. So you get a distributed grid. It's scalable. It's modular. Huge attribute. But the offset is, how do you base load that? No one wants temporary power. Right now, it's going to be coal. So I think we have to start with scenarios that solve for what everyone solves. This isn't my opinion. It is unquestionably proven time and time again. The Biden administration, we have $4 a gallon gasoline. What do? They lift sanctions on Venezuela. That's insane, Jeff. What? They're climate friendly? Give me a break. Look at Germany, right? Give me a break. You retire your nukes, you start burning lignite coal. Nonsense that anyone cares about anything other than availability 24/7, 365. And Indians and Chinese and Malaysians and Indonesians all are going to have that same right to it. And again, it doesn't matter. We can debate this till we're blue in the face. They're going to decide for themselves, and you can see the choices they're making. I think in terms of relevant feedback, it's easier for me to be a critic of some of these other scenarios produced by, again, not just the IA, but a whole bunch of big oil companies. I've not created my own scenarios other than articulating this is how I'd like to see it done. I think this is something that is work that needs to be done. I'm a small shop, if you will. I think if we were still a team at Goldman, Jeff and Dave, I think we could come up with some great scenarios of how you get everyone to be energy rich and economically rich. And then what are the different pathways of copper versus geothermal versus stuff we haven't heard of today versus some amount of crude oil and natural gas to get to where we want to get to.
I love having the group here. I think we'll have to keep these conversations going. And it sounds like from both of you, coal is the hard problem, at least one of the big hard problems we got to be working on right now. Let me turn the tables around. Arjun, what do you most want to get Jeff's perspective on right now?
The number one question I get that I've done very little work on, that Jeff, you are especially articulate on, is sort of the petrodollar economy and the changes that are. So when I talk about independence of China and India, some of it's independence from the US dollar. And I think de-dollarization to some degree is overhyped as a term. On the other hand, there are clearly some changes going on in and around the currencies that are used, the ability to convert it into gold so you're not taking on, say, renminbi exposure. But you are especially articulate on this topic, Jeff. So I know you can talk about it without me formulating a question. So I'm just going to turn it over to you.
I want to start with the point about de-dollarization. The only type of anything that's occurring in the world is de-euroization. And you look at the SWIFT transactions and everything, the euro is just going straight down. RMB, dollar going straight up, which I think is very telling, about what's going on. I live here. I love it. In fact, there's a saying, America is investable but not livable. Europe is livable but is not investable but livable. And China is neither investable nor livable. And by the way, I disagree with the China about being investable. And I'll talk about that in a second. But I do think that Europe, another way to say the same thing, somebody pointed, they said, America's a superpower of innovation. China is a superpower of manufacturing, and Europe's a superpower of regulation. Maybe that's why it's the most livable place. And I love living here, and don't get me wrong, it's a great place. But I think the regulatory backdrop has made it very difficult. And that's part of what's going on with the de-Euroization. But let's talk about your question in China, why I disagree with why China is not investable. I think it is investable. Oh, here's another stat that I learned the other day is everybody looks at the US and its equity market going up massively versus China. I think since in the last 10 years, US is up 3.5 times while China's up 30%. By the way, to show you about China is that Chinese market cap ratio with the US is constant. Here's Louis Gaub who makes this point, which I think is a phenomenal point. In contrast, the bond markets have gone up in China tremendously. So you've been invested in bonds in China, you would have done tremendous over the last decade. So you can't say it's not investable. And I think let's go about where that investment took place. And now to answer your question about what's going on with gold. China's making those goods that's going to allow India and the global south to be able to hit those numbers you're referring to, Arjun, on energy consumption. the trade that goes on in the BRICS. And it's kind of funny when Jim O'Neill, who we all, in fact, he was all of our bosses, they went, at one point in time, in addition to Steve, when he invented the BRICS, I don't think he had any clue that 23 years later, they would be meeting. Actually, there's 23 of them that met, and they're talking about how do they all trade between one another to avoid dealing with the SWIFT system. And one of the ways that they're doing that is by using gold as the currency to settle everything. And part of the reason why you see this disconnect between gold and real rates or even the nominal rates is the demand for gold out of places like China and India and Russia is unprecedentedly high. And part of that is they need to put it into their central banks to be able to settle the payments between one another to avoid having to use the SWIFT system. Even with Beijing, Beijing will bring the gold to Moscow if they need to. That's how that settlement between all of them. But what this is telling you is that those surpluses, and China's now running those surpluses similar to the sizes that we would have seen, when our heyday in 05, 06, when it was running something, in the $100 billion range. It's like $80 billion in this developed country right now. And I'm talking like that on a per month basis. The key point here is that surplus is not being recycled back into the U.S. buying treasuries like it was when we were there. Remember, because it made interest rates go down, that helped create the credit crisis in the U.S. What we're seeing is that recycling is staying in those BRIC countries, and it is going into purchases of gold, and that gold is used to settle these. So, so there is, when you look at the de-dollarization, the SWIFT system, which is the American system, it's starting to slow down, but in no way is it collapsing. In the euro, it is, but in renminbi, in dollar, it is growing. And then also when we look at gold, and I think this goes to one last point I want to make here, is that when we look at all the different markets out there, we're going through a major shift in the world. Who are the marginal buyers? What are the marginal markets? Who are the marginal sellers? Everything has changed. Look at the credit markets. We've never seen credit spreads this tight ever in our lives. They are so tight that Apple is nearly going to trade below, or the yield's going to trade through the U.S. Treasuries. Is Apple a better credit than the U.S.? I don't want to get into that debate, but it shows you how strangely priced the world markets are. The fact that I think it's 40% of AUM sits in the top 10 big countries or companies in the United States. Oil can't get a war premium bid. I can go, the list goes on and on throughout global markets. But let's bring it back to gold, your question on gold. Gold and Bitcoin, they're the ones that are capturing that safe haven bid right now. And it tells you we're going through changes in all of these things. And I think that how does it settle between Bitcoin and gold? And we have a very different dynamic with incoming administration focused on Bitcoin being a real serious contender. And I think that a lot of that's driving that. And I don't think these shifts that you're referring to, Arjun, are one-offs and temporary. I think they're a much more larger feature of the market going forward. But I want to be crystal clear. I'm not forecasting the demise of the dollar or anything like that. But I think, we're going through significant shifts here. And unfortunately, it's de-euroization is the only real one that's suffering here.
Not to put words in your mouth, Jeff, but just so I capture it, it sounds like we talked about global gas taking our whole 30-year career to get to where it was just on the cusp of mattering. It sounds like this is sort of a long scale kind of thing. We're seeing the signs, more flows into gold and these other things. On the margin, less flows into treasuries, but this is a long-term thing, not a 5-year kind of thing.
Absolutely. It's a real shift. Another point here is just the level of uncertainty around how this is going to evolve going forward, I think, is extremely high.
Thank you both for a fantastic conversation. You're making me miss the old days. Want to keep it going. So maybe one way we can think about keeping it going. My last question to you both would be, what do you think we missed today, or what questions should we be thinking about going forward? What are some of the hard problems we should be discussing? Do you want to kick that off, Arjun?
I think we covered a lot of territory. I think there's always this desire we need more markets and innovation. or we do need more regulation? And the answer, of course, is neither extreme is going to make sense. It's going to vary by country, vary by region. But if we've been in this sort of heavy sort of regulatory, here's the answer, we need X% of hydrogen and Y% of electric vehicles by Z round number a year, I think we're moving away from that. We're going to move towards more markets and innovation. I think that can be unsettling for people who say, well, we have to address this problem by this date or it's a real issue. And it's just, I don't think it's how the world actually works. You can't just have markets and innovation. You're going to need some amount of regulation. I take a topic like methane. If companies are not going to voluntarily address this, and maybe some are, some aren't, maybe that is an area where some amount of regulation is needed to specifically offer an environmental issue that I think can and should and will be addressed. On the other hand, what is that mixture of markets and innovation versus regulation? Where does it make more or less sense? I think these are topics to explore on. In addition to my overall plea, we need new scenarios that prioritize how everyone on Earth will someday be energy rich and therefore economically rich. And let's recast our frameworks in that kind of direction. And I will say, you will then get to decarbonization would be my initial reaction to that.
I'll give you the final word, Jeff. What topic should we be continuing the conversation with after today?
I just want to go to the point that Arjun just said about, market-based solutions. Yeah, the one thing I'm going to go back, as Arjun pointed out, was a Thai pot when he and I first met. That was 97, 98, when the Asian financial crisis happened. That's when markets became the answer. They unpegged all those currencies from the dollar, and you had commodity markets rising because of the deregulation that occurred under the Reagan administration. By the way, all those markets that we all were involved with, and the big macro markets, rates, commodities, FX, they all really came into existence in the mid-90s. And I want everybody to realize it was a very temporary phenomenon. Before then, it was just stocks and bonds. We really believed in these market-based solutions. They worked up until 2008. They started turning back the dial. Unfortunately, as much as I would like to see market-based solutions, I don't think they're going to be an option for us right now. We wouldn't even be having these discussions about climate change if there was a functioning carbon market. I don't think the political debate is in a place anymore where we can actually debate that and go, how are we going to get a carbon market? So, Arjun, I hear you about wanting markets to do it as opposed to policy, but industrial policy is probably something that is here to stay for a very long time, which makes getting to these solutions very difficult. It's going to create a lot of uncertainty. Best thing I can leave this on is the one thing we know with absolute certainty about whether if it is geopolitics or the war on climate change or the war on income inequality is volatility is here to stay. And that's probably the best point I think forecast I could have on the forward future.
Well, once again, thank you both. This was fantastic. I'll have to say goodbye to you both today. Thanks for being generous with your time, and let's keep the conversation going.
Thank you, Dave. Jeff, always great to see you.
Thanks, guys. It was a pleasure.
Thanks again to Jeff Currie, Chief Strategy Officer of Energy Pathways at Carlyle, and Arjun Murti, partner at Veriten and publisher of Super Spiked on Substack. We hope you enjoyed the episode. We'll be back next week with another episode of Inside the Coffeehouse. We hope you'll join us.
This episode was brought to you in part by Abax Exchange, where trading in centrally cleared, physically deliverable LNG and carbon futures contracts is now underway. Ready for smarter markets? Contact us at onboarding@abax.exchange. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.